As the global economy navigates uncharted waters, a rift emerges between the monetary policy stances of the European Central Bank, ECB, and its American counterpart, the Federal Reserve. This divergence, fueled by contrasting economic realities and differing priorities, has ignited a heated debate within the hallowed halls of central banking. Yannis Stournaras, a prominent member of the ECB's governing council and the head of Greece's central bank, has emerged as a vocal advocate for swift rate cuts. In a candid interview in London, Stournaras articulated his stance with unwavering conviction. "We need to start cutting rates soon so that our monetary policy does not become too restrictive," he asserted, echoing the sentiments of many within the European financial community. Stournaras' rationale is grounded in the sobering reality of the Eurozone's economic landscape. Economic growth in the euro area is much weaker than expected, and risks are to the downside, while inflation has come down significantly, and the risks are balanced, he stated, underscoring the urgency for decisive action. The ECB's own estimates suggest that a staggering 30% of the tightening effects from previous rate hikes have yet to fully permeate the economy, further compounding the need for a course correction. Stournaras' prescription is a measured one, advocating for 2 rate cuts before the ECB's August summer break and 2 additional reductions by year's end. 4 moves throughout the year seem reasonable. "Insofar, I concur with the market's expectations," he affirmed, aligning his stance with the prevailing market sentiment. While acknowledging the limited new information available before the April meeting, Stournaras expressed confidence that the June gathering would provide ample data to justify the initiation of rate cuts. "We will get a lot more data before the June meeting," he remarked, echoing ECB President Christine Lagarde's recent comments. Amidst concerns over the potential for a wage price spiral, Stournaras sought to allay fears, emphasizing the nuanced reality of wage dynamics. "Nominal wage growth is moderating, and profits are absorbing part of the pay increases," he asserted, downplaying the risk of a self-perpetuating cycle of rising prices and wages. Furthermore, Stournaras highlighted the lingering effects of the pandemic on real wages, noting that they are projected to reach pre-pandemic levels only in 2025. So wages are still catching up, not leading inflation. "We should not exaggerate the risk of a wage price spiral," he cautioned, urging a measured perspective on the issue. As the ECB grapples with its policy decisions, a contentious debate has emerged regarding the potential implications of diverging from the Federal Reserve's monetary stance. However, Stournaras firmly rejected the notion that the ECB should be constrained by the Fed's actions. "I don't buy at all the argument that we can't cut interest rates before the Fed does so, and almost all of my colleagues agree with that," he declared, asserting the ECB's independence and commitment to tailoring its policies to the unique circumstances of the Eurozone. "We are completely independent, and the euro area is a large open economy with a flexible exchange rate," Stournaras emphasized, underscoring the fundamental differences between the European and American economic landscapes. "We have to do what is necessary for the euro area economy, nothing else." Looking beyond the immediate policy decisions, Stournaras offered insights into the ECB's long-term strategy. He envisioned a gradual normalization of interest rates, with the deposit rate, currently at a record high 4%, gradually going down to 2% at the end of 2025 or the beginning of 2026. This level, he contended, represents a neutral stance, striking a balance between accommodative and restrictive policies. However, Stournaras cautioned against expectations of a return to the ultra-low rates that characterized the pre-pandemic era. "For the moment, I don't see rates go below 2% as it was the case before the pandemic," he stated, signaling a shift towards a more normalized monetary environment. In the wake of the ECB's recent rethink of its operational framework, Stournaras hailed the central bank's evolution, proclaiming, "We learned the lessons from recent years and have made the ECB a more modern central bank." This introspection has paved the way for a more dynamic and responsive approach to liquidity management, with the ECB poised to adapt to the evolving needs of the banking sector. "In the end, the banks will tell us and determine how much liquidity they need," Stournaras stated, emphasizing the ECB's commitment to a collaborative and market-driven approach. This flexibility, he assured, would be exercised judiciously, with the central bank prepared to intervene with more liquidity if short-term money market rates deviate significantly from the deposit facility rate. Among the key discussions shaping the ECB's future is the establishment of a new structural bond portfolio. Stournaras acknowledged the potential stabilizing effects of such a portfolio, asserting, it will help to stabilize the economy. However, he cautioned that the details, including the inclusion of government bonds, must be carefully navigated to ensure compliance with the European Union's prohibition on monetary financing. We will make sure that it doesn't violate the prohibition of monetary financing in the EU treaty, Stournaras affirmed, outlining potential safeguards such as maturity limits, adherence to the capital key, and issuer and issuance constraints. Another pivotal discussion centers on the future of longer-term refinancing operations, a critical tool in the ECB's arsenal. Stournaras revealed a division within the Governing Council, with some members favoring a continuation of the fixed-rate full allotment approach, while others advocated for alternative strategies. I and others would be in favor of sticking to the fixed-rated full allotment also for longer-term operations. Other colleagues have different views, he acknowledged, underscoring the ongoing deliberations and the need for a comprehensive evaluation before reaching a consensus. As the ECB navigates the intricate web of monetary policy decisions, Stournaras' resolute stance serves as a clarion call for decisive action tailored to the unique challenges facing the Eurozone. His advocacy for rate cuts, grounded in economic realities and a nuanced understanding of wage dynamics, reflects a pragmatic approach to safeguarding the region's financial stability. Moreover, Stournaras' unwavering defense of the ECB's independence and his rejection of the notion that the central bank should be beholden to the Federal Reserve's actions underscore a commitment to charting an autonomous course. This independence, coupled with a willingness to adapt and evolve, positions the ECB as a dynamic institution poised to confront the complexities of the modern economic landscape. As the debates rage on, one thing remains certain: the ECB, under the guidance of visionaries like Stournaras, is steadfast in its commitment to flexibility, responsiveness, and a relentless pursuit of economic stability for the citizens of the Eurozone.